So for the first question for depreciable asset building, the timeline is between 1 of January 2017 to 31 December 2021. So the first one, for the gap year, it is 5 years because we count from 31st of December 2017, 2018, 2019, 2020, and 2021. And for the second thing to calculate is the pre-revaluation reserve for the building. And we can see here the carrying value and fair value during the acquisition date, which is the 1st of January 2017. So the fair value is 5 million and the useful life is 32 years. And to calculate the carrying value, we firstly do the formula CV minus 5 years of the gap years, and in the bracket CV we divide by 32 years, which is the useful life, and we equals it to the 4.6 million, which is the value of the building during the SOFB in 2021. And the CV equals to 5,451,851.85, and we search for the differences between the fair value and carrying value, and we will get a decrease of 451,851.85. So now we do the journal entry. We debit pre-revaluation reserve and credit building with the value of 451,851.85. And for the third thing to search for is the post-revaluation reserve, meaning that in between the timeline, if there is more fair value, so we need to calculate the fair value and compare it with the carrying value. And during 31st of December 2018, there is a fair value of 6.2 million, and we take the fair value from the most recent fair value, which is 5 million, and we minus by 5 million, divide by 32 years, multiply by 2 years. Why? Because we firstly need to search for the carrying value, depreciation, and we multiply by 2 years because the first year 31st of December 2017 and the second year for 31st of December 2018. So that is why we multiply by 2 years, and we will get 4,687,500, and the differences is 1,512,500, and we debit building, credit post-revaluation reserve with the same amount. And for the next revaluation reserve, there is a recent fair value on the 2019, so the fair value is 5.4 thousand. And to search for the carrying value, which is we take the fair value from before, 6.2 million, we minus by 6.2 million, divide by 30 years. Why 30 years? Because the initial useful life is 32 years, and since then already 2 years has passed, so that is why we need to 32 years we minus by 2 years, so 6.2 million divide by 30 years, and we will get 5,993,333.33, and that is for the carrying value. And compare it with the fair value, we will get 593,333.33, and debit post revaluation reserve and credit building with the same amount. So why we need to do like this? Because the fair value is lesser than the carrying value, so there is a decrease in the amount of the building. And moving on to the next one is the depreciation adjustment. So we have two depreciation to search for. The first one is the subsidiary depreciation, and the second one is the parent depreciate the subsidiary's asset. So for the first depreciation is carrying value from 1st of January 2017 until 31st of December 2021. So the timeline, the gap year is 5 years, and we take the carrying value from the acquisition date, which is 5,451,851.85. We divide by 32 years to find the depreciation for each year and multiply by 5 years to get the total from the acquisition date until the SOFP date, and we will get 851,851.85. And for the next depreciation is we need to search separately because there is a few fair value that needs to be taken into consideration, because we have 3 fair values. So for the first one is 5 million. We divide by 32 years and we multiply by 2 because of the 2 years gap until the new fair value, and we will get 312,500. And as for the new fair value, we take 6.2 million, divide by 30 years because since then 2 years has passed, and we will get 206,666.67. And for the last one, 5.4 million, divide by 29 years, multiply by 2 because there will be 2 years until the most recent date, which is 372,413.79, and the total for these 3 value is 891,580.46. And to search for the differences between these two depreciation, we will get 39,728.63. And as for the last one is the console SOFP, as year ended 31st of December 2021. The non-current asset is building, which is 5.4 million. We minus by the depreciation 372,413.79, and we will get 5,027,586.21. And for the equity, we will take 1,512,500. We minus by 593,333.33. Why we don't plus? Because in the journal entry just now, we debit post RR, meaning that it is a decrease in the revaluation reserve instead of an increase, and we will get 919,166.67. Moving on to the next timeline, which is starting from 1st of January 2015 until 31st of December 2019. So the gap year is also 5 years as we count it separately. And for the pre-RR building, the fair value is during the acquisition date is 450,000. And to calculate the carrying value, we use the formula CV minus by 5 years, which is the gap year, and in bracket CV over 14 years, which is the useful life, and equals to the SOFP value during the most recent date. And as we calculate it, we will get the carrying value of 575,555.56. So we put it on the carrying value and we search the differences between the CV and the FV, and we will get a decrease of 125,555.56. So we debit pre-RR and credit building with the same value. And for the post-revaluation reserve, the fair value recently is 560,000, which is on the 31st of December 2016. And we will take the fair value from before, which is 450,000. We divide by the useful life, 14 years, and we multiply by 2 because we need to search from before until the most recent value how many years. So 31st December 2015 and 2016. So there is an amount of 2 years gap. So we will need to 450,000, we minus by the depreciation, and we will get 385,714.29. so the amount of CV, we put it in the information and search for the difference. So there is an increase of 174,285.71, and we debit building and credit post RR with the same value. And for the next post revaluation reserve, the fair value is the fair value during the 31st of December 2019 is 620,000, and we take the fair value from before, 560,000. We divide by 12 years because 2 years has passed, and in the future there is 3 years until the new fair value, so we multiply by 3. And the depreciation, we take 560,000, we minus by the depreciation that we calculated, and we will get 420,000. So compare the carrying value and fair value, we will get an increase of 200,000. So we debit building and credit post revaluation reserve, which is 200,000. And moving on to the depreciation adjustment. So for the first one, subsidiary depreciation, we take the carrying value, which is from the 1st of January 2015, the acquisition date, which is 575,555.56. We divide by the 14 years, which is the useful life, and we multiply by how many gap years there is, which is 5 years, and we will get 205,555.56. And for the parent depreciating the subsidiary, the first and the second year is the same because there is no new fair value, which is 450,000, divide by 14 years and multiply by 2 years. We will get a total of 64,285.71. And for the recent fair value, which is on the 31st of December 2016, so we start to depreciate it on the 2017. So 560,000, we divide by 12 years and multiply by 3 years, which we will get 140,000. So total up is 204,285.71. So comparing the differences between the two depreciation, we will get 1,269.85. And lastly, for the consolidation of the SOFP on 31st December 2021, for the non-current asset, the building value, we take the most recent fair value, which is 620,000. And for the equity revaluation reserve, we plus the 174,285.71, we plus with 200,000, and we will get 374,285.71.
Next, for question 3, the building was bought on 1st January 2019 with the fair value of 2.4 million and useful life is 23 years. In the 31st December 2020, the fair value increased to 3.4 million, and in the 31st December 2023, the fair value decreased to 3.2, and the value of the building in the SOFP is 2 million. The cap year for the building is 5 years. Firstly, to calculate PRR, we need to find the CV on the 1st January 2019, and to calculate CV for the date is CV minus with 5, which is the gap year, times with CV, divide with 23 years. And we will get the amount of CV 4,088,888.89. The CV for 1st January 2019, which is 4,088,888.89, minus with fair value for the 1st January 2019, 2.4 million, we will get PRR 1,688,888.89. So in the journal, the debit will be building 1,688,888.89, and the credit will be PRR 1,688,888.89. Next, to find the first post RR, the CV for the 31st December 2020, to find it is 2.4 million minus with 2.4 divided with 23 years times with 2 years, we will get the CV 2191,304.35. So the amount of CV minus with fair value 3.4, we will get the post RR 1208695.65. The journal will be debit building 1208695.65 and the credit will be post RR 1208695.65. For the last post RR, to get the amount of CV 3.4 million minus with 3.4 divided with 21 years times with 3 years, we will get the amount of CV 3076190.48. So the CV 3076190.48 minus with FB 3.2 million, we will get the post RR 123,809.52. The journal would be debit post RR 123,809.52 and the credit will be building 123,809.52. Next, for the depreciation adjustment for sub C, we will take the amount 1688888.89 divide with 23 years times with 5 gap years, we will get the amount 367,149.76. And then next, for the parent depreciation, firstly, we need to calculate the first post RR, which is 2.4 million times with 23 years times with 2 years, we will get 208,695.65. And for the next depreciation, 3.4 million divided with 21 years times with 3 years, we will get 485,714.29. And the total of the both depreciation will be 694,409.94. For the differences A, which is the subsidy depreciation, and B, minus with B parent depreciation, we will get the amount 327,260.18. So in the journal, it will be debit depreciation RP post 327,260.18 and the credit will be accumulated depreciation 327,260.18. For the extract of statement of financial position as at 31st December 2023, non-current asset building will with the amount 3,200,000 and the equity revaluation reserve 2,773,775.02. In question 4, the building was bought on 1st January 2020 with a fair value of 750,000 with a useful life of 19 years, and in 31st December 2020, the fair value of the building increased to 800,000. In 31st December 2024, the fair value of the building decreased to 650,000 and the value of the building in statement of financial position is 400,000. To find the PRR, we need to minus CV with FB, but the CV aren't given, so we will need to calculate it. The formula for the CV is CV minus with 5, which is the gap year, times with CV divided with the year of the useful life, which is 19 years. And we will use the amount of the building in the SOFI, which is 400,000. Next, the equation will be 19 CV minus with 5 CV equals to 400,000 times with 19. And after is 14 CV equals to 7.6 million. And the amount of CV that we have found is 542,857.14 cents. So that's the CV amount that we have calculated, and minus with the FB, which is given 750,000, we will get PRR 207,142.86. In the journal, it will be debit building 207,142.86 and credit PRR 207,142.86. Next, for the post RR, we also need to minus CV with FB. FB already been given, which is 800,000, but the CV aren't, so we need to calculate. So to calculate it is 750,000 minus with 750,000 divided with 19 years, and we will get the amount of CV 710,526.32 cents. And after minusing it with the FB, we will get the post RR 89473.68. In the journal, it will be debit building 89473.68 and credit post RR 89473.68. And for the last post RR, the CV is 800,000 minus with 800,000 divided with 18 years times with 4 years. We will get the amount of CV 622,222.22 minus with FB 650,000. The amount of post RR is 27777.78. In the journal would be debit post RR 27777.78 and credit building 27777.78. Next, for depreciation adjustment for subsidy, we will take the value of PRR in 1st January 2020, which is 207,142.86. Divide with 19 years times with 5 gap years, we will get 54511.28. For the parent depreciation, first is 750,000 divided with 19 years, we will get 39473.68. And the second depreciation, 800,000 divided with 18 years times with 4 years, we will get 177,777.78. Total up the both depreciation, we will get 217,251.46. And next, we will need to find the differences between A, the subsidy depreciation, and B, parent depreciation. We will get 162,740.18. So in the journal, it will be debit depreciation RP post 162,740.18 and credit accumulated depreciation 162,740.18. Lastly, for the statement of financial position as at 31st December 2024 extract, in non-current asset, we have building with the amount of 650,000, and in equity, revaluation reserve with the amount of 268,838.76.
Question 5, depreciable. It started on January 1st, 2010 till 31 December 2014, and it took 5 years between that timeline. First step is pre-RR. We need to find the CV in 2010, which is we already got the fair value, which is 3.5 million. To find the CV, we need to CV minus 5 in bracket CV over 40 years, because the useful life is 40 years, and we will get the amount of equal to 1.6 million, and we will get the amount is CV 1,828,571.43, and key in the CV, and we will minus with 3.5 million, and we will get the amount of 1,671,428.57. Key in this amount in the journal 1, which is debit building, and credit pre-RR as 167,428.57. For the second step as post-RR, we need to find the CV again in 2012. FV 2012 is 4 million. We will take the amount of 4 million. And to find the CV, 3.5 million minus with 3.5 million over 40 years, but times with 3, because 2010 till 2012 is 3 years, and we will get the amount of 3,237,500, and key in the CV above, and minus with the 5 million, and we will get 1,237,500. Put it in the journal as debit building, and credit post RR as 1,237,500. For the second post RR is we need to find the CV again in 2013, which is the FV. We will take the 5.4 million, and to find the CV, 4 million minus 4 million over 37 years, which is we need to 40 years, we need to minus with 3 years and multiply it for 1 year, and we will get the amount is 3,891,891.89, and that amount as a CV, and minus with the 5.4 million, and we get the amount 1,508,108.11. Put it in the journal as debit building, credit post RR as 1,508,108.11. For the third post RR is we need to find the CV for 2014. The FV for 2014 is 5.8 million, and to find the CV is 5.4 million minus within bracket 5.1 million over 36 years, that we minus 37 with the 1 year and multiply it with the 1 year, and we will get the 5,250 50,000 and put it in the CV and minus with the 5.8 million, we already get 550,000. And debit, put it in the journal as debit building, and credit post RR as 550,000. And for the depreciation or adjustment, the first step is the subsea depreciation of CV from 2010, from January 2010 till December 2012 is take the amount of pre-RR and divide by 40 years time with 5 years, and we will get 208,928.57. And for the parent depreciation for the subsea, we will have the 3.5 million. We have the total of 3.5 million over 40 years times with 3, 262,500. For the second one is 4,037 years times with 1 is 108.11. For the third year is 5.4 million over 36 years times with 1 we will get 150k. And for the fourth year is 5.8 million divided by 35 years times with 1 equal to 165,714.29, and the total up is 686,322.40. And the differences between in the number 1 subsea depreciation and the parent depreciation is 208,928.57 minus with 686,322.40 equal to 577,393.83. And the last step is for the journal, we key in it in the journal as debit depreciation 477,393.83 and credit accumulated depreciation 477,393.83. For the statement of financial position as at 31 December 2014, under the non-current asset, we will have building as 5.8 million, and equity revaluation reserve, we will need to add all the RR in credit side, and we will get the amount of 4,967,036.68.
Hi, Assalamualaikum. My name is Nur Alisha. So today I'm going to explain question number 6 for depreciable assets. So I will guide also throughout the pre-revaluation reserve, post-revaluation reserve, and depreciation adjustment, also the soft P itself. The first part is we need, as you guys can see from this question, the acquisition date is on 1st January 2013, and the gap between this acquisition date until 31st 12 2017 is 5 years. Okay, for the first step is we need to calculate the pre-revaluation reserve. First is we need to come out the fair value amount, which is, as we can see from this question, the fair value amount on the 1st January 2013 is 1 million. And then for the carrying value, we cannot take from the soft P itself. It is because this is a depreciable asset, and from this question we need to understand that the subsidy are not record the recent fair value, so parent need to record and compare by the time acquire. And pre-revaluation reserve is the amount before parent acquire. So how to find the carrying value for this question is we need to calculate by CV minus 5 years, which is the gap, times with CV over 35 years, which is the useful life, and equal with the amount from the soft P, 940k. And then by doing the mathematical calculation, we will get the CV amount, which is 1,096,666.67. And this amount we need to compare with fair value amount, and we will get 96,666.67. And this we will need to put on journal, which is debit pre-revaluation reserve and credit building, and the amount is 96,666.67. Why debit pre-revaluation reserve? It is because the carrying value is more higher than the fair value. The second step is for the post-revaluation reserve. As you guys can see from this question, there is two fair value, which is from 31st December 2014 and 31st December 2016. We need to calculate one by one, which is the first one is on 31st December 2014, and the fair value amount on that date is 1.4 million. How to calculate the carrying value? We cannot take the carrying value from the fair value before the date. We need to calculate by CV is equal 1 million, which is the amount from the fair value before, minus with 1 million over 35 years, times with 2 years, which is the year gap between the fair value to the current fair value now, and we get the answer is 942,857.14. Same thing, compare with the fair value amount, we will get 457,142.86, and then record on the journal debit building credit post revaluation reserve, the same amount, which is 457,142.86. Same thing on the third step, which is post revaluation reserve. On 31st December 2016, come out the fair value amount, which is 2 million, calculate the carrying value, and we will get 1,268,750. Record on the journal the amount that we compared between CV and FV, which is 731,250. For this depreciable asset, we have to calculate the depreciation adjustment, which is for the first part is subsea depreciation, which is we need to come out the amount of CV on the first January 2013, 31st December 13, and 31st 12 14 until the fair value amount. How to calculate is take the amount of pre-revaluation reserve times with over with the useful life times with the gap of the years for these timelines, and then we will get 13,809.52. This one is for subsea. Next, we calculate for parent depreciation subsea. We need to calculate one by one. As you guys can see from this question, I took 1 million over 35 years times 2, which is the gap until 31st 12 14, and then for 31st 12 14, I took the amount 1.4 over the balance useful life 33 years times 1, which is gap until 15, and then last but not least, took the amount for fair value on 31st December 2016, which is 2 million over the balance useful life 32 years times with 1 years. Add all the amount, and then we will get 162,067.10. Between subsea and parent, we need to find the differences. After find the differences, we will get 148,257.58. This amount we will record on the journal entry, which is debit depreciation, which is retained profit post, RP post, and credit accumulated depreciation, which is put the amount 148,257.58. And then last but not least, the last step is do the statement of financial position as at 31st 12/17. We have non-current asset, which is building 2 million, which is the latest fair value amount, and equity revaluation reserve 1091,726.19, which is the amount of the revaluation reserve, and minus with the pre-RR because the CV is more bigger. That's it from me. Thank you.
For the question 7, non-depreciable, the gap years is 5 years between 2015 till 2019. And first step, we need to find the pre-RR for land. And CV 1/1/2015, which is we need to take the amount of SOFP in 2019, which is 11 million, and minus it with the FV in 2015, fair value 10 million, and we will get 1 million, and key in the journal debit pre-RR 1 million and credit land 1 million. For the second step is post-RR. In 2017, the CV we will take the 10 million, which is the previous year, and the FV we will take the 2016 12.2 million minus those two, and we will get the 2.2 million. Debit land and credit post-RR 2.2 million. The third step is post-RR. For the next year is 31 December 2019, which is 12.2 million as the CV, and for the FV is 13.7 million, and minus those two, and we get 1.5 million. Debit land credit post-RR 1.5 million. And for the statement of financial position as at 31 December 2019, under the non-current asset, we will have land as 13.7 million, and under equity we will get revaluation reserve 2.7 million. Question 8, non-depreciable, the gap years is 5 years between 2020 till 2024. And the first step is pre-RR for land. We need to find the CV, which is the SOFP in 2024, which is 2.5 million, and the fair value at 1 January 2020, which is 3.6 million in 2020, minus those two, and we will get 1.1 million. Key in those amount in journal, debit land 1.1 million and credit pre-RR 1.1 million. Second step is post-RR. For the first one is on 31 December 2022, the CV is 3.6 million, which is the previous fair value, and the fair value is 4.3 million, which is the current in 2022, and minus those two, and we will get 700k. Put it in the journal, debit land 700k and credit post-RR 700k. And the third post-RR is CV 4.3 million as a fair value, as a CV, and fair value is 4.1 million as a in 2024, and minus those two, and we will get 800k. Key in the journal, debit line 800k and credit post-RR 800k. Put it in a statement of financial position as at 31 December 2024. Under non-current asset, we will have land for 5.1 million, and equity, under equity we will get revaluation reserve 2.6 million.
Hi, good morning everyone and madam. Today I will explain the solutions for question 9 and 10, which is for non-depreciable part, by involving the revaluation of land over a 5 years gap. This explanation will include the calculating both pre and post revaluation reserve by adjusting the fair value. Okay, Okay, based on this question 9, the acquisition date, as we can see, it's on 1st January 2013. First thing, we should do the pre-revaluation reserve, which is take the amount of carrying value, which is 820,000, taken from the statement financial position as the land's books value. We take 820,000 from the SOFIE is because it's recorded the carrying value, and we need to compare this to the market value, which is the fair value, to ensure the land is accurate value. So the fair value, the amount is 910,000, which is on the acquisition date. And then after compare the both value between CV and FV, we get 90,000. And then the amount we calculate, we have to put on the journal entries, which is debit land 90,000 and credit pre-revaluation reserve 90,000. Why land is credit? It is because to reflect the increases in asset value, and also the pre-RR on credit because to record the revaluation surplus. Okay, the second step is to calculate the post-revaluation reserve. As you guys can see, there is two fair value amount after the acquisition date. First on 31st December 2014 and second is on 31st December 2016. So we need to calculate one by one. So the first one is on 31st December 2014. Come up with the carrying value, which is 910,000, which is the updated from the pre-RR adjustment. Next, the fair value amount. And the third step is for post-revaluation reserve for the second part, which is on 31st December 2016. And the amount of carrying value is 980,000, and the fair value amount is 1,350,000. And the differences is we get 370,000, and this amount we put also on the journal entry. Debit land 370,000, credit post revaluation reserve 370,000. After done do the journal entry part, we should do the statement of financial position as at 31st December 2017, which is there is two items we should put on the SOFP. First is non-current asset and second is equity. Under the non-current asset, put the land amount, which is on the fair value amount, the latest fair value amount. However, for equity, the item is revaluation reserve. Put all the amount revaluation reserve from the journal entry. Add all the amount, and after we calculate all the amount, we get 530,000. And as we can see from the soft P, it shows the cumulative increase in equity. Now I will continue for question 10. Same question for non-depreciable. As you guys can see, this question, the acquisition date is on 1st January 2017. Same thing we can do, which is the first step is find the pre-revaluation reserve, which is on the date of acquisition, 1st January 2017. The carrying value is 12.2 million. It is also taken from the SOFP as the book value before the revaluation, and then took out also the fair value amount, which is 13 million, and then compare the amount for both CV and FV. We get the amount is 800,000. This amount we should put on the journal entry, which is debit land 800k and credit pre-revaluation reserve 800k. Second step is for calculating the post-revaluation reserve, which is on 31st December 2017. The carrying value is 13 million and the fair value is 14.6 million. Calculate the differences and we get 1.6 million. And then put the amount on the journal entry, which is debit land 1.6 million, credit post revaluation reserve 1.6 million. Last but not least, the second post revaluation reserve, which is on the 31st December 2021, come out the CV and FV, which is 14.6 million and 15.7 million, and the differences we get 1.1 million, also put on the journal entry, 1.1 million debit land and credit post revaluation reserve 1.1 million. And then same thing as question 9, do the statement of financial position as at 31st December 2021, which is on non-current asset. There is land on it. In it, put the amount 15.7 million, which is the latest fair value amount. And then for equity revaluation reserve, take 3.5 million, which is the amount, the total amount of revaluation reserve from the journal entry itself. And that's it from our group. Thank you.